Two people sell long-term assets. Both make big gains, but one pays huge taxes while the other pays zero tax. How? Watch the full video to know how. The one who paid zero tax used a section of the Income Tax Act 1961, Section 54F, which corresponds to Section 86 of the New Income Tax Act 2025. What this section does is that it helps you save tax on long-term capital gains from assets like shares, mutual funds, gold, land, or commercial property. But there's one condition. The asset sold should not be a residential house. To claim this benefit, you must also use the sale money to buy or construct a residential house in India. And here's the most important point. Under Section 54F, you do not reinvest only the capital gains, but you reinvest the net consideration. That means the entire sale amount after deducting any sale-related expenses. Let's understand this by an example. Let's say you bought stocks for 10 lakh. Later, you sold them for 50 lakh. Your gain in this case is 40 lakh rupees. But to get the full benefit of Section 54F, you must invest the entire 50 lakh amount in the new house, not just the 40 lakh capital gain. But wait, there are some really important conditions that you should keep in mind. Now, what are these conditions? First, the asset sold must be a long-term capital asset, that is land, equity, mutual funds, gold, etc. Second, it cannot be a residential house. Third, you must buy or construct a residential house in India. You can buy the house within 1 year before the sale or within 2 years after the sale. You can also construct it within 3 years after you have made the sale. Now here's what you must not do. Do not sell the new house within 3 years. If you sell it, the earlier exempted gain will be taxed in that year. You also should not own more than one residential house on the date you sell the asset. And you should not buy or build another house during the allowed 2 to 3 year period. Now there's also a cap under this section. If the new residential property costs more than 10 crore, only 10 crore will be considered for exemption. But what if you cannot reinvest the money before filing your ITR? Then deposit the amount in Capital Gains Account Scheme or CGAS. This keeps you eligible for the tax exemption. Now what happens if you reinvest only a part of the sale amount? Then you get only a proportionate exemption. So what is a proportionate exemption? Let's understand this by another example. Let's say you bought a land for 5 crore. You later sell it for 10 crore. So your long-term capital gain in this case comes out to be 5 crore. If you invest only 5 crore in a new house, your exemption will be 2.5 crore using this formula. But if you reinvest the entire 10 crore, the full 5 crore capital gain can be exempt. Now you might have another question. Can you claim Section 54F for 2 adjoining flats? Yes, if the 2 flats can be used as one functional residential unit. But if they are separate flats in different locations, the exemption will apply only to one of them. So here's the bottom line. Section 54F can legally help you claim LTCG tax exemption up to 10 crore. But you must follow the conditions carefully. And to get the full benefit, you must reinvest the full net consideration and not just the capital gain. What if you sold a residential property and are now worried about a big tax bill? Watch our previous video to learn how you can save taxes on that too. For more such wealth wisdom, scan the QR code and follow ET Wealth on WhatsApp.